every single reason, we'll look at every reason that gold is going to 4,500. And I'm talking about this year. When you aggregate that, unofficial, unreported 400 ounce PBOC monetary gold demand, which is never ever disclosed, liquidity providers estimate this is very likely to 40%. This is not going unnoticed. It's not going unnoticed that the PBOC has stepped up selling US Treasuries, that means selling dollars, and buying gold with the proceeds. Now, the aggregated demand alone is conservatively estimated to raise the price target to $4,500 per ounce.
One of the most significant developments quietly reshaping the global gold market is the newly mandated directive for Chinese insurance companies to allocate 1% of their assets into physical gold by the end of 2025. This policy is expected to absorb around 400 tons of gold, roughly 8% of the annual global mine supply. Even more impactful is the decision by China's 10 largest state-owned pension funds to shift 1% of their portfolios into gold, a move that could consume up to 30% of the global market. When factoring in the continued unofficial monetary gold purchases by the People's Bank of China, PBOC, total Chinese demand could account for up to 40% of the world's available gold supply, a move that signals deepening skepticism toward traditional financial instruments. In parallel, the PBOC has continued to reduce its holdings of US Treasuries, redirecting capital toward gold accumulation, a strategic shift in how China manages its foreign reserves. Bloomberg has reported that the central bank has issued new gold import quotas to commercial banks, a move intended to accommodate rising demand from institutional investors and private buyers alike. According to gold market analyst Andrew Maguire, each ounce entering China becomes part of the country's permanent state inventory. This structural shift, he argues, is creating a visible and lasting supply deficit, one that traditional bullion banks can no longer ignore. This accelerated momentum is already reshaping global expectations for gold. Opening Q1 2025 at approximately $2,650 per ounce, gold has surged over 17%, outperforming traditional benchmarks such as the S&P 500 and Bitcoin. Maguire had forecast a $3,000 price target by the end of Q1, an estimate surpassed weeks ahead of schedule, with gold reaching $3,100 by mid-April. Following this milestone, Maguire revised his projection to $3,500 by the end of Q2. As of mid-April, gold is already trading at $3,300, and the breakout above this key level on April 12th has added credibility to his next forecast of $3,500. This upward trajectory reflects a broader structural transformation in the gold market, driven by sovereign accumulation, institutional repositioning, and a growing global reassessment of fiat currency stability. Now, we present the clips from Andrew's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
On an even bigger limb, Shane, and target a physically driven gold price that not just reaffirms our 1st of January estimation of a minimum of $4,000 per ounce by the end of the year 2025. Because why? Because we see the PBOC active, and it's now bringing the bullion banks in to understand how they can quantify supply demand. I figure now that is too conservative. And what we're going to do is we're going to look at every single reason. We'll look at every reason that gold is going to 4,500.
So let's step through this. On the 1st of March of 2024, the PBOC opened up the Shanghai Futures Exchange, and that was gold trading, enabling gold trading to be accessed by commercial and private citizens. And as we've tracked every month since then, it was clear that this was an official strategy to drive massive gold investments into China. And from the open of the 1st of March 2024, this launch, into the end of the year, and this is the 31st of December of 2024, so into the end of the year, we evidenced gold rising by an unprecedented $760. And then we saw that initially here, and we saw a little bit, here, but then we saw a little bit of a pullback into the end of the year. Essentially, this is also, and this is why we have a note here, this is where repatriation also commenced. And that was as soon as it was known that Trump was going to take the helm. And suddenly we had the realization that there was going to be audits and one thing and another. So, we're covering several things here. But essentially, we're really looking at this China investment. So the reason we're looking at it now, and despite the end of the year rinse, which we saw, it still ended up closing, physical gold still ended up closing $620 higher than the strategic Shanghai Futures Exchange launch. The reason we're talking about it here, by no coincidence, 1 year later, and we're looking at this now, in the early stages of the second quarter of 2025, we're witnessing a similar officially sanctioned, commercially targeted gold buying mandate being sprung on the West, driven by a directive for Chinese insurance companies to invest 1% of their assets into physical gold. And as we drew attention to in our last episode, it will require an even larger percentage of available gold mine supply to be drawn down into China by the fourth quarter of 2025. And this kind of leads us to some targets. Now, these were originally, if you remember, we had all of these circled in previous episodes, 3,000, 3,100, 3,200, etc. And we've had to move the Basel III from 3,300 to 3,500. And we'll go through why in a minute. And we'll go through what all of this means. Now, this is the spot gold chart, not the futures charts. So, and again, also the spot chart here on a daily basis. Now, as we will look at shortly, the current PBOC mandate will easily match, if not surpass, a similar $800 higher price than was benchmarked at the end of the first quarter. And that was benchmarked at where the BIS, where the Fed BIS squared their BIS borrowed swaps at spot 3,100. And as we will look at, these higher price estimates are quantifiable. This latest PBOC mandate alone conservatively puts the Chinese-driven gold price at 3,900, and that is conservative. In fact, all the Western bullion banks have woken up to quantifiable supply-demand metrics that price gold around these levels or higher. When I say these levels, I mean $800 higher than 3,100. Also, every ounce of gold that enters China stays in China and by proxy is collectively owned by the state, so can be easily accessed in times of war. And we've already previously looked at how 25,000 tons of citizens' gold could be patriotically leased from citizens by the state in a time of war. And while we read this as a military war, there is no reason why it could not be accessed in a financial war, which we're looking at that being foreshadowed right now. Furthermore, it's no secret that Beijing's monetary gold purchases have not yet been counted as official reserves, which when aggregated with what is salted amongst the state-held banks and very large 400-ounce gold held by the generals, is far closer to 40,000 tons. And that's in addition to what is held by citizens. If and when it suits Beijing to reveal these true reserves, I don't want to digress, so we will look at how linked with Russian reserves, these gold reserves will ultimately widen the scope of the digital RMB, and we'll look at that shortly. But bottom line, the major bullion banks are aware gold that enters China does not return, which is why the bullion banks have woken up to looking at quantifiable supply and demand metrics that value gold between $500 and $1,200 higher. And we're going to look at where Goldman has brought forward what was originally expressed as a tail risk of 4,500 as being brought potentially forward to the end of 2025.
The global gold market is facing a significant and growing structural deficit, currently running at around 900 tons per year, with forecasts indicating this gap could widen to 1,200 tons by the fourth quarter of 2025. This imbalance, driven by a combination of factors, creates consistent upward pressure on gold prices. One of the most notable contributors is China's policy of retaining all imported gold within its borders, effectively removing that supply from the global market. This strategy, combined with increasing global demand for gold, is forcing major bullion banks to adjust their pricing models. These banks have begun revaluing gold by $500 to $1,200 higher based on the tightening supply and heightened demand. As China continues to absorb more of the global supply, it is driving the need to recalibrate gold's value on international markets. A clear indication of the shifting dynamics in the gold market is the widening gap between physical gold premiums and paper contracts. In April 2025, physical gold premiums over COMEX futures surged to 6.7%, the highest since 1979, reflecting an increasing preference for tangible assets over paper-based derivatives. This shift in preference underscores a broader trend, where investors and institutions seek more secure and stable stores of value in uncertain global economic conditions. As a result, Goldman Sachs has adjusted its tail risk projection for gold, moving its estimate for $4,500 gold forward from 2026 to as early as 2025. Their quantitative models now support price targets ranging from $4,200 to $4,800 due to supply constraints and growing global demand.
An unfactored drain on demand, and it's not going unnoticed by these extremely well-connected bullion banks who, having filled their boots long before publicly raising their gold price targets, they're now doing so on a weekly and now on a daily basis, alongside end of first quarter higher gold price estimates from several bullion banks. That was JP Morgan, UBS, Deutsche Bank, Citi, and most notably Goldman Sachs, who reaffirmed tail risks of a $4,500 gold price in 2026, possibly being brought forward to 2025. It's these factors that are making them take notice. It's notable that these 2025 targets, which our first-tier liquidity providers, including Goldman Sachs, have been sharing with us here since January, they're now being openly shared publicly. Why? Because they filled their boots already. And we know these bullion banks have been long and strong for their own books since the Bank of International Settlements short-covered all their swaps and leases on the 1st of November 2022. And these banks have now stepped up accumulating gold for both their house and their client accounts ahead of US Basel III compliance on the 1st of July. And these repatriations have to be concluded before the end of this second quarter because there's going to be an audit. Now, please also remember, through all of this, we've been reporting very, and I mean very in capitals, large official-sized Indian and Chinese demand over the last few weeks that have preceded all of these price upgrades. Now, with the cat out of the bag, Chinese institutional demand, which has been waiting for an end of the month, end of quarter pullback, they took everything on offer into that dip. And following unprecedented tariff escalations this week, leaching into a financial war, China has stepped up selling dollars, treasuries for gold. This includes as yet untapped pension fund demand, which we refer to, which liquidity providers had already reported began picking up on the 1st of April. Well, we're only on the 16th here now. Now, as was noted by Bloomberg here in this link, in addition to the pension fund gold buying mandate, the PBOC has also allocated fresh gold import quotas to commercial banks to meet increased demand from institutional and retail investors amid escalating trade war. And I mean, a quote from their, this is what they said: to meet significantly increased appetite. This flies in the face of some Western reports of a lack of investor and jewelry demand due to higher prices. well, says it all. It's quite the opposite of a lack of jewelry demand. The bullion bank expectations of hundreds of dollars of higher gold prices this year are driving a fresh influx of very sticky CTA, that's commodity trading advisor, Western traders, ETF buyers, COMEX demand, which complements what's going on, which ironically is underpinning dips and forcing Asian buyers who would love a discount. So Asian buyers of jewelry and investment bars are having to accept higher prices. What's happened is the bullion banks have woken up. They've woken up to the fact that there's a quantifiable metric in place that values gold higher.
Central banks are expected to continue reshaping the gold market by aggressively increasing their holdings, with their share of total gold demand anticipated to rise even further. Since 2022, central bank demand for gold has more than doubled, indicating a strategic shift toward gold as a safer, more stable asset. This trend highlights a pivot away from fiat-backed instruments like U.S. Treasuries, with central banks decreasing their participation in sovereign debt markets. As a result, global reserve strategies are likely to evolve, with gold becoming an increasingly crucial asset for long-term stability. Additionally, China's growing demand for gold, driven by official and institutional purchases, is expected to influence gold prices significantly in the coming years. How do you think the increasing demand for gold will impact global markets in the coming years? Share your thoughts in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.